Hello and welcome to the latest investment market update. I'm Brian Morman, Chairman of Brunston Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Brunston investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. In this video, Mark will be answering some topical questions and provide us with a wider context as to what has been happening in investment markets. Mark, interest rates and inflation. Interest rates have quadrupled in recent times. What are your views on the recent action by the Bank of England?
Yeah, hi, Brian. I mean, as I speak to you now, we've just seen some more inflationary data come out from the UK literally a few hours ago. That shows that inflation is remaining high, remaining sticky, hasn't really moved from where it was in the previous month. And indeed, parts of the inflation sort of background, as it were, have actually got a little bit worse, with core inflation continuing to rise. So against that sort of inflationary backdrop, at least within the UK, we're almost certainly going to see further interest rate rises from the Bank of England. They will be announcing the decision again tomorrow as I'm speaking to you. But we will obviously know more as to the degree of the rate rise that they will be making after that meeting. But it is very likely that they will raise rates at their meeting tomorrow. And the question really is whether they continue or how far they continue to raise rates against that backdrop. So we definitely are seeing inflation remaining sticky, and on the back of that, we are seeing continued interest rate rises from central banks that at the moment don't necessarily look like they're likely to stop anytime soon.
Inflation rates have been around the 11%, down at about 8-9% at the moment. But of course, interest rates are the main tool to bring this down. So interest rates have a big effect on the economy. Mark, how is this likely to affect portfolios?
Yeah, obviously the biggest direct impact on increasing interest rates is more on the economy than anything else typically, and we will see parts of the economy begin to become more expensive, frankly. Mortgages obviously being a very obvious one, but also corporate loans and some other parts of the sort of the way that the money moves around will essentially become more difficult for the portfolios. We're quite defensively positioned, as it were, with regard to fixed income, which is the most directly exposed element of the portfolio to interest rates and interest rate rises. So we've got quite short duration bias within our portfolios, which don't tend to move as much when interest rates go up. But it does also present some opportunities, because at the moment we can get some very defensive bond funds that are paying us sort of 4.5%, 5.5%. That has not been possible really for 15 years or so. Those are presenting more of an interesting opportunity for us to be looking at from an investment viewpoint. And increasingly, we're beginning to see that actually some of those bond funds have the capacity to be included into portfolios where maybe previously they were not. So it's a new, it's not a new part of the investment universe, but it's a part of the investment universe that we have not really sort of delved into much over the past sort of 15 years with a view to generating decent returns. That has now started to change, and indeed, as those interest rates go up, it could well be that the yields on those will continue to rise, and we can try to make sure that if we remain short duration, we don't necessarily see any capital downside or limited capital downside to some of those positions.
So turning more to not only the UK, but more globally, Mark, what are your views on long-term interest rates and inflation?
Yeah, I mean, the inflationary story in the UK is quite a bit worse than other developed economies. I believe equivalent figures from the US are substantially lower than they are in the UK. But so are other European countries as well. Germany and France are good examples of that. So we are seeing the inflationary story in other parts of the world maybe not being quite so bad as they are here. But the trend at the moment is that inflation is remaining sticky. It is not coming down as quickly as maybe some economists forecast. It's remaining a little bit more elevated. And so I think that we could probably expect interest rates globally to remain higher for longer. And that does mean that we are seeing sort of variations within the appeal of areas such as fixed income from different parts of the world. But it also does mean that clearly, we are getting some better yields that we can now take advantage of in that fixed income space. But I think one of the key messages really is that don't expect, or our thoughts are, don't necessarily expect interest rates and inflation to sort of fall off the edge of a cliff unless we see some sort of economic disruption of some description, which would drive that. So, at the moment we are sort of on this sort of slight kind of tightrope where, we don't necessarily want inflation to continue to increase globally, but equally the most likely way to bring it down rapidly would be an economic shock. So, we sort of want this path of steady inflationary decline, and we'll have to see if that pans out as the sort of next sort of months and possibly years pan out.
Yeah, a number of clients ask us, do we hold on to our investments at the moment? Do we cash in? Do we invest more? Is this a good time to invest? And I think what you're really saying there, Mark, is that things are likely to stay as they are for a little while. But if people have got some spare cash out there at the moment and they feel on a medium to long-term basis it's right, then it could, of course, be a good time to invest.
Yeah, potentially. And when we're looking at certain assets like equities, despite the recent rally that we've seen, we're still sort of the fundamentals over the longer term are looking quite compelling. And as I said, you can compare, you can combine some reasonable longer term returns from the equity market with some better yields that you can achieve from the fixed income market to hopefully generate some reasonable longer term returns. But I do caution that we could see further near term volatility in both the equity and the bond market, but we expect longer term returns to probably be quite positive.
Okay, well, thank you, Mark, and thank you for watching. As always, if you have any questions, then please be in touch with us. Thank you.